This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of the show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Investor Connect is a 501c3 nonprofit dedicated to the education of investors and startups for fundraising. Please consider donating $100 to the program to help others in their investor and entrepreneur journey. You can find the donate button on the investorconnect.org website. Hello, this is Hall Martin with Investor Connect. Today we're here with Judah Taub, managing partner at Hetz Ventures. Hetz Ventures is a leading Israeli seed stage venture capital firm taking a thematic approach to early stage investing. With nearly $300 million under management, the fund invests in and supports startups in DevOps, dev tools, and open source, AI data, fintech, cybersecurity, and other enterprise verticals. Judah, thank you for joining us.
Thank you for having me.
So where are you calling from today?
I'm in Jerusalem at home.
Great. Good deal. So tell us more about your background before joining Hetz Ventures.
So I was in the military for 5 years. I did a variety of different things to do with data there. I was at a hedge fund afterwards. I was 5 years head of data at a fairly large hedge fund based in London. And then following that, we started Hetz in 2018.
Great. And so what excites you right now?
A lot of different things, but from a sector perspective, the sectors you mentioned early on are probably the ones that are most interesting to us still. So DevOps, dev tools, things that are typically sort of productivity enhancement. We're very fond of those.
Cool. So you see a lot of startups and a lot of investors out there every day. What's your advice for people investing in startups? What do you tell them to do before they write that check?
Are these professional startups or are these individuals? Who am I talking to here?
I would say any investor that's an angel or venture capital or family office. So someone that's making a serious investment with some serious money.
Okay, so I mean, it's very different between those individuals. But I would say, number one, you should ask yourself of why this deal has come to you. Frequently, I mean, in Israel, you hear of a lot of people who come over here and then say, you wouldn't believe what startup I happened to meet on my visit that I came to Israel. And they'll tell me some story about how it happened to me that I met this one cybersecurity company, which is just like incredible. So often the best companies will know how to navigate themselves to the most suitable investors. And if you happen to be somebody that doesn't come from this sort of sector and doesn't typically invest in these types of startups, I would start off by asking why I have this deal. If you're a more institutional investor, you do this more regularly, then I would talk about maybe a strategy that you want to try and put together. My guess is for venture capitalists out there, this is something they do fairly well, or at least they ask these questions fairly frequently.
Well, great. Then on the other side of that table, what's your advice for people running startups? What do you tell them to do before they go out to raise funding?
So a lot of things. If I had to just pick one, it would probably be, I actually find myself saying this to entrepreneurs quite often, and especially this was true in 2021, but I think it's no less sort of true in 2022 in the new environment that we're in today, is the person who's taking the biggest bet on your startup is you. It's not the person giving you the money, it's you. And the reason for that is, take me as an example. I mean, we work very, very hard to try and make sure that the startups we invest in are good ones and are disproportionately successful. Having said that, we have a portfolio of these. We're not putting all our eggs in one basket. And the entrepreneurs are by definition doing that. And if you're a really good entrepreneur, then especially sort of at the very beginning, you have a big opportunity cost that you're paying to do your startup. So the test of whether your startup is a good idea is not whether you can persuade a venture capitalist to invest. The test is whether the startup will end up being very successful down the line. So you, as an entrepreneur, really need to build the conviction yourself. Doesn't mean to be closed-minded to others, but you've really got to believe in it yourself. And the success mark is not going to be, well, I raised X amount of dollars at whatever valuation. It's am I going to build a big business? Have I built a path that I really believe in? I can get proof points along the way, not raising money, real proof points from the ground from customers, from whatever the startup is, that it reinforces that belief.
Well, great. Well, let's talk about the state of startup investing. How do you see the industry evolving from here?
Well, today we're in a very different environment than we were definitely sort of 3 or 4 months ago or 6 months ago. But the environment has changed sort of quite dramatically. Just to double click on that, the way I see it is that there's two trends that we were seeing in quite an extreme way over the last couple of years, which was sort of the KPIs that startups had to reach to qualify for their next round coming down. So you once had to hit sort of, I'm talking, say, for B2B software, Series A. It used to be sort of $100,000 in MRR, recurring revenue, sort of monthly recurring revenue bills. That moved to booked, moved to $1 million in ARR, which moved into sort of like potential sort of $1 million by the end of the year, which at some point transitioned to sort of stars on GitHub, which then transitioned to like, I mean, I'm making a little bit of a joke here, but the reality is these KPIs trended downwards sort of pretty rapidly. And then the flip side was the amount of money that you raised when you hit those KPIs was more and more. So you used to raise, when you hit that, whatever that metric was of your Series A, used to be sort of $6, $7, $8 million. That moved to 10, 11, 12, which then moved to 15. And then you started hearing even crazier numbers. I'm talking in averages here, but it was moving up. So basically what was happening is you ended up having a situation where you didn't have to get as far. And when you got there, which wasn't as far, you got a lot more money. So it's a very friendly environment for an entrepreneur. If you think of an analogy of somebody running a marathon, it's somebody running a marathon that is constantly being given more energy to get to the end, and actually the finish line is moving closer every time. And now what we are is we've had those two trends reverse. We've had people sort of start asking questions about the size of the rounds, how much money they have to give these startups, which I think is reversed, not is in such a meaningful way yet. But the second KPI, which has happened much bigger, is that you actually have to hit milestones that are much harder than you were told a year or two ago. So what's happening now is the opposite. Entrepreneurs who built their roadmaps a year or two ago thought that if they only reach sort of this milestone or whatever milestone they set out, they would easily raise the next round at an evaluation that was very, very comfortable for them. And what they're finding out today is that milestone is actually not the same milestone anymore. They actually might have to get a little bit further than that. And not only that, when they do get a little bit further than that, the carrot at the end of it is not quite as big or as juicy. You can quantify it however you want. So the market has clearly changed quite a lot, and we're very much in the middle of it. Especially at the later stages, it's not where we invested today. It really is sort of a tough market. I think where we are today at the earlier stages, it's you see many more folks investing, but it's still in full swing.
Great. So what do you think is the biggest change you'll see in, say, the next 12 months in the startup world for funding? Which way do you think it's going to go?
It's exactly that. It's exactly what I just explained. I mean, 12 months ago, people were deploying capital at a rate never seen before. VCs were raising capital in cycles of 18, 24 months. Reserve ratios were down below sort of 1-to-1. Some people were literally reserving nothing. And these things are flipping back. People are not going to go back to market as quickly. They're going to sort of extend their investment period back to sort of 3 years, 4 years, some people maybe even longer. Stretching the math is quite painful. So just to double click on that, if you are a venture firm, taking an early stage firm, when you have, say, $100 million that you're investing, $50 million a year, so 50 1 year, 50 the second year, you then turn that into 4 years. If you're halfway through your cycle, you now have to take the $50 million that you're left and spread that over 3 years. I mean, I may have gone into a little bit of sort of complex math, but if you actually do the math on a fund that's halfway through, you'll find that it means that they're going to be deploying sort of roughly 70% less capital. I've put on a few blog posts of this as well, if anybody is actually interested in seeing the math, but it means that capital can dry up sort of pretty quickly and people can slow things down quite dramatically.
Great. So let's talk about your investment thesis for your fund. What exactly is it, and what's your criteria for making an investment?
Yeah, so we're pretty thematic. And what that means is that we have a pretty strong top-down approach to what we do or why we do what we do. So we're first of all we focus on a specific geography. So we focused on Israel. A lot of entrepreneurs are not always based in Israel, or even those that do end up moving out of Israel at some point to carry on growing their companies. But we have a pretty strong focus on Israel, and that's where we have a very, very strong network, and we see a huge portion of the deals. The second thing we do is we focus on a number of specific sectors, or verticals, you can call them, which are the ones that you read out earlier. But just to maybe to explain it slightly differently, we're all technical. We all have a software background in some shape or form in different areas, and we've all worked internationally in those areas. So these are the type of startups that we're going to naturally sort of feel closer to them. And then the third and final one is that, so we're not only focused on a geography and on verticals, but we're also very focused on the stage that we invest in. And so every investment that we've made to date is on seed companies. 90% of them we've led. And if you sort of cross those three sort of data points that I get together, that's where we focus. And we think that that's actually the right place to focus, and that the returns there from a thematic perspective, putting aside stock picking, will be sort of compelling and strong regardless of any sort of stock picking abilities, which we think we do relatively well.
Great.
Regardless.
Well, can you talk about a couple of startups, perhaps portfolio companies that fit your thesis?
Yeah, I mean, all of them. So I would argue maybe the most interesting thing is that they all do. Unlike many other VCs out there, and there's a strong argument for being opportunistic, we are not. We are thematic with our approach. We know exactly what are the types of startups we are likely to invest in, and which are the ones we don't mind that we didn't see them at seed or at Series A. They may be great, but they're outside of our thematic approach. And as a result, every single startup in our portfolio will fall, some of them in a more obvious way than others, but into that thematic approach that I just described.
Great. Well, let's talk about the challenges for the startup and investor in today's economy. You've talked about it a little bit before, but for example, the startup that maybe raised at too high of a valuation, how do they overcome that challenge at this point? What can they do to get out of it?
Yeah, so there's a number of things. So growing your top line obviously won't hurt. So you can, to an extent, sometimes grow out of your problem. The other one is we're big sort of proponents, very much in favor of taking a down round or a flat round rather than compromise on the type of investors that you raise money from, or compromise other types of terms that sneak into the term sheet. I think if you take a down round or a flat round or an up round, but not the up round you initially imagined, you are still sort of on track to success. You have, just like the public market, adjusted your valuation. And from here on, hopefully, it's sort of up and to the right, or you're sailing with the right direction, etc. Other areas that you can try and put a band-aid on, like taking money from investors you wouldn't have imagined taking it, moving down the tiers, or with certain types of clauses that can sneak into the term sheet. Those are things that, while they may make you feel good at the beginning, are more likely to hinder your startup long term.
I see. And then, on the investor side, what is the challenge they face in today's market? What do you see them struggling with the most?
Investors?
Yeah, on the investor side, during the pandemic, I saw a huge number of startups out raising funding. And from my point of view, there was just a lot of noise in the marketplace. That seemed to be a bit of a challenge just to sort through to find the real deals. I think after the pandemic and recent change in the market, as you said, a lot of those are out of the way. They're not in the market anymore. There's less noise. There's only real deals in most cases out there. So if you look, you lose. But still, it's a lot simpler to go look through. But what challenges are you seeing?
I would disagree, first of all, with what you said. I think that apart from the first maybe 3 months in the pandemic, where people really did stop and sort of wait, the last 18 months were, I don't want to say unprecedented, like I haven't been around that long, but definitely sort of from the years that I've been around and from most of the folks that I've been speaking to, unprecedented, definitely in the last sort of couple of years, with the amount of companies that have been raising, the amounts they've been raising, the valuations they've been raising. And as a result, I'd say today there is a lot of companies out there that I don't want to say shouldn't have got funded, but definitely shouldn't have got funded at the valuations they got funded and the quantities they got funded. And now, like, investors, I think, have sort of two challenges. So number one, they're all asking themselves, how does this market pan out? And there's always a big price one pays on uncertainty. So have we hit the bottom? Are things going to deteriorate from here? Just knowing the answer to those questions would give everybody a lot of comfort, because things, as I mentioned, are still sort of very much at play. And then the second is that there's a lot of companies out there that, even with the rejigging of their formulas and trying to cut costs, are going to need to come back to market with very different pictures than they initially imagined. So investors don't want to sort of be overpaying at this stage, especially in today's market. And at the same time, their own portfolio is probably not doing as well as they initially imagined they would do 12 months ago. I mean, there's so many stories of startups that have grown 100 or 200 or sometimes even 300 or 400% their revenues, but their valuations are still sort of dropping below what they initially imagined. So for investors, like, this is not a fun time either. They're trying to understand, quantify the new scenario, sort of try and figure out what they're doing with their portfolio, and then also sort of build a new investment thesis that they can run with.
Great. No, that's good advice there. And so you see a lot of different sectors and applications and technologies out there. If you were in a place to start a business tomorrow, what would you start a business in that would leverage your experience from looking at all these different technologies out there?
So I'm not sure that I'll speak about myself. I think as a VC, you really build a skill for identifying over time where there may be problems, maybe sort of raising flags as a board member early on, helping to steer people in the right direction. That is a very, very different skill than coming up with an idea, and actually sort of an innovative idea, and sort of pushing it over boundaries and through. Like, the areas we like are areas that I mentioned earlier, like productivity enhancement, which could be in areas like dev tools, and it could be in other areas as well. And the reasons we like them is because they're really quantifiable. You can really go to the customer and see how much, whether it's time, whether it's a cost, whether it's anything else, this is actually sort of saving or enhancing. It's really quantifiable. It's easy then to sort of roll out a plan, envision how this works at scale. So we like that element. But just going back to your question, I wouldn't give myself particularly high scores on coming up with a new idea, because I've been in a VC for a couple of years.
Great. Okay. Well, in the last few minutes that we have here, what else should we cover that we haven't?
I mean, overall, I think these questions have been good. No, I think everything's okay. I mean, be interesting to see the market, as you mentioned, in 6 to 12 months' time. I think overall it will also do a lot of good. It's worth mentioning. It's not easy. It's not fun, and it will be painful both to investors and to entrepreneurs. But if you look at sort of the startups that did sail through previous crises or crashes or big swings, they tend to come out much stronger on the other end. And I think it would do a lot of good to the industry overall.
Great. Well, so how best should listeners get back in touch with you?
I'm on LinkedIn, so it's pretty easy to reach out there. We also have a website. We've got a whole bunch of people on our team which are much smarter, nicer, better than me in a lot of different areas. So they should feel free to reach out to everybody at Hetz.
Great. We'll include that in the show notes, and want to thank you for joining us today, and we hope to have you back for a follow-up soon.
Thank you.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.